righty, I would like to start the meeting if everybody's ready.
Yeah.
Good evening. This is the July 28th, 2020 meeting of the Trumbull Pension Board. It's being conducted by Zoom. And we have a quorum. And as is our practice, I'm going to turn over the meeting to the Byrne Wealth Consulting Group, who are going to give us an investment update. So John Oliver, if you would take over.
I'll actually turn over to Lynn.
Okay.
Sorry. Technical difficulties
Technical difficulties, okay.
we've ever had as a group on here. So
I'll start. So good evening, everyone. On behalf of myself, John Oliver, and our team, thank you for the opportunity to present this evening. I hope you and your families are safe and healthy. Tonight, we'll review the second quarter report as well as provide a market overview. As always, just please stop us if you have any questions or concerns. Maria, thank you for sending out the reports that we have. And if you could turn, I don't know if you printed them out, but it's page 7 of the PDF. And it is page, excuse me for 1 second.
Yeah, what's the page number at the
Sure,
bottom?
it's page 3. So it's total plan performance. We'll review that first.
Okay.
Let's see that. Okay. Does everyone have the report?
Yes, I do.
Okay, so the second quarter total assets were $38.63 million, increasing by $5.3 million since the end of first quarter. This also includes the $1.4 million contribution that occurred for the third and fourth fiscal quarters as well. The total, I'll just do an overview of the different allocation spaces, and then we can go into any detail you'd like us to. And just to mention, in the domestic equities, East Bay, which is about 0.06 of the portfolio, because obviously, as we all know, it's been liquidated, will receive those proceeds in September. We're still in communication with their firm as to when the proceeds are coming in, and we'll, of course, let you know as soon as they are wired to us. The total equity of the plan is 55.21%. The return for the second quarter was 20.65 and is down 8.77 year to date. The domestic equities were 40.28% as of 6/30. 3-month time period, they're up 20.49 and down 9.4%. If you turn to the page, next page, which is page 8 of the PDF and page 4 of the actual report, the international equities, which are 14.93% of the portfolio, are up 21.55% for the 3-month time period and down 6.71 year to date. The fixed income and credit space, which is 26.39% of the portfolio, that was up 5.29 for the 3-month period and up 2.91% year to date. Inflation protection and alternatives, which consist of the Boyd GSA as well as the Boyd State, and then the Longford 2 fund. And just to mention the Longford 3 fund, there's a $2 million commitment. We've put $100,000 in so far, but there's just no performance numbers on that that investment yet. It's 9.87% of the portfolio. The 3-month period, they were up 1.54, and year to date, they were up 1.86. And just to mention as well, the performance information that we provided for Longford 2 is as of March 31st, as the June 30th statement is not available as of yet. And then the cash equivalents are 3. Sorry.
When
Yes.
will that June 30th statement will be available? Do you know?
I can find out. It most likely will be available in the next few weeks, but I'll certainly find out from them.
Yeah, because we're getting ready for the audits. So I want to make sure I have the final one.
Of course. I'll
Okay.
email them as soon as I get off the phone with
Great.
you.
Thanks.
And the cash equivalents were cash equivalents were 3.293, 8.53% of the portfolio, up 0.05 for the 3-month period and up 0.51 year to date. So that's an overview of the portfolio, and John Oliver is going to speak about the markets at this time.
yeah, I would just add too on the Longford number, the Longford 2, it's not in there. There was also a settlement and a distribution that's not in there, and they also just had another capital call. So we got money back, and then they just called capital, I believe they called about
80,000. It's
What?
80,000. 80,000.
80,000.
That's
Yeah.
due on August 10th. So we just sent it over for signature today.
Yeah, I was just thinking percentage-wise, they called, I think, about 4% of committed capital. And then the distribution and the settlement was from actually one of the other cases that had settled. They had another another defendant in the case settle. So they got another distribution, which equated to about 1% of committed capital in the fund. So we got that maybe a week or so ago, and then we'll have the numbers around that to update June pretty soon. I feel like going back to the end of June is a little dated, but if everyone goes to page 1 in the performance report that just has the market performance overview, this is starting to change a little bit, and I'll speak to it, but this is really kind of similar theme to last meeting I spoke about. If you look at page 1, where it has all the different indices for US, international, fixed income, real estate, and then it has the 1, 3, 5, 10, et cetera, annualized years of performance. But the biggest thing, and one of the things I'll just touch on, which looks like it's starting to change a little bit in the very short term here, and I'll speak to why we think that is if you go down and you look under US equity at the Russell 1000 growth versus the Russell 1000 value, and the disparity between the two indices. And I kind of spoke about this before. The main difference between the two indices are that in the growth industry, it has more technology, and in the value industry, it's more financials, or just think about it as more cyclical stocks. And when we look at the year-to-date difference, you can see growth, which contains technology, also a bit of healthcare, is up almost 10% for the year, and the value index is down 16% for the year. So, it's still something that's, I don't want to say an anomaly, but it's a big split. And it's probably one of the biggest splits for growth and value. And I kind of sound like a broken record, I'm sure, since I said this last meeting, since the late 90s and early 2000. So we have this split. And what we've been doing is, even though the S&P, for example, is up or back kind of probably flat for the year this year, underlying the S&P 500, if you really strip out kind of growth stocks or technology stocks specifically, and some healthcare stocks, you really see that several sectors in the S&P are down anywhere from, call it 10 to 30% for the year. So what we've been looking to do and allocating here with the cash, and then we got some more cash in, so that raised up the portfolio cash a bit. Again, what we're looking to do in here is allocate to a lot of the sectors that have really been kind of decimated by the coronavirus, and then also had lagged for a long period of time going into this environment. Mainly when we look at the global economy, the central banks, governments, et cetera, I keep saying 30 trillion, but I think now it's probably more like 40 trillion worth of stimulus have been pumped into the economic system to kind of stave off the effects of the coronavirus and any impact it may have, even though it's having severe impact. But from an economic point of view specifically, and going into recession, I think what all the world governments are trying to do are trying to prevent anything worse from happening and going into a more depression. So as we look at things today, if we get any type of opening, and this is obviously barring a second wave spike, barring that, it looks like there's going to be a tremendous amount of liquidity in the marketplace. You're going to have that liquidity most likely go into wherever it can go into, meaning risk assets. Usually it'll go into equities and kind of credit that's more economically sensitive. So if this economy begins to open up more and more, we don't get a second wave, I would imagine we're going to have a pretty big movement up from here in the entire equity landscape. So from our purview, where we're seeing that that's going to take place most likely based on kind of what's developing, we're starting to see the dollar weaken quite a bit relative to where it's been. So what does that traditionally mean when you have a weaker dollar? Risk assets perform better. And what risk assets perform best in those environments tend to be more economically sensitive and cyclical things, such as commodities, industrials, materials, I would say more value-oriented parts of the market. And then beyond that, what we're seeing is the weaker dollar. We're starting to see a pickup a bit in the international markets relative to US. This is more kind of transpiring in the last couple weeks or so here. So that's been kind of the biggest change that's taken place in the broad economy. That doesn't mean we don't think growth stocks are bad, but just the disparity between the two and the economy opening with the liquidity and a weaker dollar should really fuel those stocks to go higher. So as we're sitting in here, we're getting a little volatility, but we're looking to kind of deploy most of that cash where it's not needed for capital calls back into kind of some value into the market, meaning larger value stocks. We have some small and mid cap exposure in there. Increase that a tiny bit more, and then also look if there's an opportunity set in developed international. The emerging markets look extremely attractive to us, generally speaking, and on a relative value basis. I think the biggest concern we're having there right now is that when we think about the emerging market, China makes up kind of 35 to 40% of that total stock market, depending on which kind of metric you use. So I think one of the big concerns we're having around emerging market exposure at a bigger scale than we have it in the portfolio here is, what does it mean with global tensions between US, China? Is that going to negatively impact the emerging market economies? And we think right now there's, even though that from a value point of view or from a price point of view looks very attractive, we think there's probably a better risk reward trade-off in developed international and also in US, specifically value. So even though the markets rallied back broadly as an index, underlying that, there's some pretty big discrepancies that we think there's a lot of opportunity just kind of when we start to slice parts of the market from growth, value, and then when we start to look at, if you took like the technology stocks, for example, and compare them to financial stocks and just the disparity between the two, and even if you got more granular and you just picked one of the big banks versus one of the big technology companies, like look at the performance of like a Microsoft versus a Bank of America or something, for example, you can see just the huge disparity between the two. Bank of America, for example, and I'm not saying one's good or one's bad. I'm just saying the disparity between the two performances across kind of these big companies that make up, say, the S&P or the Russell 1000 are enormous right now. So we think the opportunity seems like to us it's going to be more into this side of the market that we're going to look to add more from cash into equities to get the equity exposure back to 60% or so, which was pretty close to that. And then the cash injection came in and kind of lowered it. So, that kind of for the month kind of hurt us a little bit as we got towards the end of the month here, where we had a bit of a rally and we had a kind of elevated cash position more so than we had in the beginning of the month. So not that much change in kind of what we're looking at from last month when we spoke to this month. But the one big thing we're seeing is just the change in the dollar strength and that really weakening, and you're seeing a bit of some things rally that pretty intensely, whether it's gold or precious metals or some commodity stuff that hasn't, has gone up here, obviously, because of the coronavirus and a perceived safe haven of assets, but really move up as the dollar has been kind of weakened over this time period. So that's kind of the biggest thing we're seeing in the last couple of weeks. And then obviously the stimulus package, what that's going to look like, and how is that going to get into people's hands over the next time period here. So if we don't get a second wave or a second shutdown, and although there's certain places in the country that are spiking, we obviously have done a great job in Connecticut in terms of controlling a lot of the cases, but when you look at some of the other places that haven't implemented the same type of measures, whether it's Arizona, Florida, and a bunch of other states, you can see they're getting, I think I read today or late last night, that Florida has the most cases, more than New York now, more documented cases than New York. So when you think about New York and kind of in our area around here being the epicenter, to think that Florida has more cases now, pretty scary thought. But if we can get that under control and we can continue to open the economy safely, I would think that's going to be pretty positive for equity markets. But we're still pretty sad. We got a huge amount of unemployment in the United States and that, but just talking about it strictly from being an asset holder, whether it's equity or debt, it looks like it's going to be a positive thing, at least short and medium term for risk assets, but longer term, certainly we're going to have to figure out what the solutions are just to some of the debt issues and beyond. So.
John Oliver, you're mentioning you want to increase exposure to U.S. value stocks. Is that primarily through the two AQR funds that you would do that?
I wanted to actually see if it was okay with the board, because I as a recommendation, instead of adding more to some of the AQR, if it would be okay if we added to just the Russell 1000 index, as opposed to, because what I'd like to do beyond the AQR funds is get just kind of a market cap weighted exposure. So instead of having, say, the S&P, it's just the Russell 1000 value index, and kind of to balance off. When I think about, we have kind of an active manager in value with Diamond Hill. We have a quantitative manager with AQR, and I just like to add kind of the index at a low cost way to get that broad exposure for the time being, as opposed to increasing more of the AQR funds. But I know that's not a position we have in the portfolio, so it was something that I wanted to bring up, to just get pure kind of market cap weighted exposure at a low cost.
Do you need somebody to make a motion, or normally I would think that's sort of up to your discretion?
Yeah, the only reason I wasn't sure and haven't added that specifically to the portfolio is because technically it was a new position, or like a new index. So I just didn't know if I had, quite frankly, the authority to add a position. I know I have authority to increase kind of the equity, but as we're doing that, I said, I don't want to just add this position without making it explicit to the board, kind of that I wanted to add it. So that was my only concern around doing it, or else if I knew it was okay, I just would have kind of started to open that position. But I just wanted to make sure it was okay with the board as to why we're doing that. I feel, we have enough exposure with AQR. I'd like to see kind of their part of the portfolio start to outperform and improve. And I think we can still get some value exposure without going in that specific direction.
Yeah, I'd be happy to make that motion if you think that's appropriate, Jim.
Jim, you want to make that motion? And
I move that we give Byrne the authority to add a Russell 1000 index ETF to the portfolio, up to 5%, let's say.
Yeah, perfect.
And is there a second?
Second.
Jim Daly. Discussion. I think it's a good idea myself. All in favor?
Aye.
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 Opposed? Abstain? It's unanimous. Okay, John Oliver, you got that?
That's it. That's the only
Can I ask a question on that? Would you be moving from another fund in order to create this one?
No, great question, Maria. No, we would move from the cash position we have because we have about a pretty elevated cash position. So we start to do it. The first allocation would be, so we'll do it in stages, but the first one, when we open the position, will probably be around 2 to 2.5% as we start the position. And then as we're getting some days, we're getting some kind of, it looks like we're getting a bit of consolidation here. So we want to use this consolidation to kind of increase that position. So we'll start at about probably 2.5% and then go from 2.5 and work our way up to 5. If we get a big sell-off in a certain time period here, for example, we're not anticipating that, but let's say we get a day here where there's a big down day, we may end up doing slightly more than that just to get some more in at a quicker rate.
Yeah, because I was wondering about that cash. There's a large amount of cash in
Right.
there right now.
Right. I think right before we had the money come in, I think we were down to about 3% of a cash position in the portfolio, and this added about a little over 5% cash. So it kind of jumped up our cash weighting quite a bit.
And we don't have a big need for cash in the near future, right, Maria?
Oh, just the monthly disbursements, which they're approximately, is it $1 million something? I'm not
Yeah,
sure.
I think it might have been $1,125,000.
Yeah,
Like that.
yeah.
Right. Yeah. I might have it in the report here. Yeah, so for the first quarter of, for quarter 2 for 2020, about $1 million, just under $1.4 million went out of the account.
Okay, so that's per quarter, yeah.
Yeah. So the benefit payments were 1,384.
And when is the next disbursement?
Right now, there should be one payment, so 1/3 of that will go out now. So 300,000-400,000 a month approximately.
And we still have about 3.3 million in cash, or it's probably gone down a little bit,
Right.
or will soon go down a bit, I guess.
So does it make sense to buy something else? I'm just putting it out there. And leave less cash, or this is not the time?
Yeah, so we're gonna add to the value index, and then we'll probably add as a breakdown. I'll send it to everyone before. We'll probably look to add, call it maybe another percent into a percent to a 1.5% between the mid cap and the small cap stocks. So that'll kind of get us just broad value. And what I mean by that is just technically smaller companies kind of have more of a cyclical orientation because they're more, I would say, sensitive or economically sensitive traditionally than kind of large cap stocks are. So that's one way we'll be able to pick up a little bit of a little more cyclicality in the portfolio. So between getting to about 5% in the Russell 1000 and then another, call it 2%, that's 7%. That'll bring us down, our cash position down to call it a little less than 2%. And then we have, like I said, we have a capital call for Longford going out. So that'll kind of put us right in a range where we'll have enough cash to function for payments and distributions without really having to kind of sell anything to raise cash per se.
Because if we're putting out roughly 4% in disbursements per quarter, unless we're planning on making another deposit, that cash position will come down pretty steadily over the next 6 months, it'll be pretty much, down to a pretty low level, unless we add more cash, I guess.
Oh, yeah, we do have payments that go through the general fund every quarter or as needed. And I think Anthony waits till he talks to John Oliver or Lindsay to determine when he moves those funds. So there are funds available to put into the plan.
Okay, good. So that would suggest then we could use the cash to fund adding to equities. Thank you.
Okay. I see, John Oliver, you have a couple of funds on the watch list. Do you want to briefly mention your thoughts on those?
Yeah, so as part of our process, anytime we have any fund that goes through kind of two to three consecutive quarters of underperformance relative to a specific benchmark, we put it on the watch list, mainly to understand, well, why is it missing the benchmark? And then, is the reason that it's missing the benchmark because, for example, the strategy's changing, the management team's changing or something? So it's just to keep us, for lack of a better term, us on point and honest as to what's going on with the fund. So when we look at the AQR funds that are missing, we understand why they're missing kind of the benchmark, and really the reason they're missing their benchmark is a lot to what I've said here, where they have a big component of the portfolio in a type of value investing that they look at companies and they group them by the price of the asset relative to the book value of the asset. So if you add the debt plus the equity together, how much are you paying for that asset? And so what they're looking at is assets that have a low price relative to the book value of their tangible book value of their assets. So essentially, that's a long way of saying those companies tend to be very cyclical and value oriented at this point, and generally, but at this point, and they're probably much more comprised in the Russell 1000 Value Index, for example, and their index they're going against is the Russell 1000 Value for one of the funds, for example. And so the Russell 1000 Value, if we look at it, has had such a big dominant part of it be growth and technology stocks, that those stocks, which they don't own as many of in their portfolios relative from a weighting point of view and relative to the benchmark, have really driven kind of that. I mean, we could say on an absolute basis, if we just want something that goes up with the benchmark, but it looks like going forward, there's going to be a better upside to those that portfolio, as opposed to just say being broadly into the Russell 1000 index itself, which has a lot of technology. I mean, we still like technology. It just looks to us like that's had such a parabolic move. I mean, I guess equities, anything could happen, and they can, you can go insane before you can be rational. But in the meantime here, if we're getting this opening with stimulus in the market, it would seem like that portfolio is poised to kind of outperform its index by quite a bit. Starting to see it in certain, a little bit for the quarter and certain of the value components, but we haven't seen it because it's really started to take place more and more over the last few weeks, last 2 to 3 weeks, where we're seeing this dollar weakness, more stimulus, economies opening, and you're starting to see a bit more of a kind of, I would say, I mean, not that one day means anything, but even if we look today, like the NASDAQ was down probably twice of what, say, like the Dow was down today. So when we're looking at, we're starting to see a bit more of that play out day to day and week to week in the data. So we don't have any recommendation on a change, but that's why we have them on the watch list and why we're looking at them. Know the management teams, know the style of investing we're doing. Quite frankly, if we were in any type of kind of I would say that's more of a quantitative way to invest, and any type of quantitative investment style right now, unless it was in a more momentum style, which means just like what you're following from a quantitative point of view, what's gone up the most in the last quarter or the last month, or depending on how you view that philosophy. Anything that's more value oriented that has a long-term quantitative approach has really just lagged in general, broadly as a category. So it's not that they're just behind, it's that entire classification of investing is behind their kind of relative indexes, if that makes sense how I explained it.
Yeah. Fine, thank you. More questions for John Oliver, or John Oliver has something additional to add? I mean, we have,
Yeah, I mean, I would just add, I know, we've had a good upside here. We're behind, quote, call it the 60-40 or the policy, but I think what we'll be able to do by getting some more of this cash allocated into some of these areas of the market that have really been, in my opinion, they've been just depressed. I think we'll have a good opportunity here to, in an appropriate way from a risk reward point of view, kind of make up a bit of ground on that. I mean, yeah, with the cash coming in kind of hurt because we were getting closer to that kind of 60% equity, but it didn't hurt in the sense because it looks like we're going to have an opportunity here with some of the sell-off coming in this little week or two here with volatility to be able to get some of this cash into the market at some better pricing.
John Oliver, I see a lot of information about Longford here, which is
Yeah.
great information. Maybe you could summarize, we're doing well, that was a good decision, that sort of thing, or not?
Yeah. So it looks like to us and I'll just kind of speak to it in this way. On the Longford 2 fund, because like Lindsay mentioned, we are just starting to call capital for Longford 3. It looks like we're gonna, on the realized investments so far, we're making about 1.7 times our money, and the investment life of each investment currently is running about 1.6 years, call it. So we're running a pretty short investment period for this type of fund for each investment to settle on average. And we're getting a pretty high multiple on those realized investments. On the partially realized investments in the fund, we're making about 1.4 times our money. So for every $100 we're putting in, we're getting $140 out. I would think that it'll get more towards the 1.7 to 2 range. And then I would think that on the unrealized investments, what we'll end up, I think we'll end up pretty close to 2 times our money on the fund at the end of the life cycle. So I think as of now, and to not have, everything kind of looks silly to be invested in other than technology stocks. But in terms of risk and volatility, we've had, it's been a fund where we haven't had to experience the market, and specifically stock, but even in the bond market, volatility up and down. And we're kind of consistently getting distributions of capital and getting capital called, and getting a good return on that money. And I think some of the cases that are still outstanding or pending that they're looking to settle will be some big numbers for the fund, it looks like.
And their business has not been impacted by the virus situation?
From my conversations with them, they haven't had anything impact. The courts maybe have slowed a little bit, but even the court stuff has gone. Oh, sorry, guys. A lot of stuff has gone digital with the courts, or digital remote, where they've been communicating over the phone. So it's maybe slowed things a little bit, but part of the conversation with them, it's actually also given them an opportunity where certain cases that maybe people didn't have as much motivation to do, they're seeing more motivation. So it's given them a lot more cases to look through that they think are of value. They've also hired, since the start of this, they've brought on, I believe, and I'll get this back to 3 people onto the team since then, as they've expanded. They brought in the most notable hire was a former, I believe, appellate court judge who prior to that was a patent lawyer. So they're adding people to the team who I think that they can deliver value when they look through and they kind of vet these cases that they're trying to settle. So I'll get an update if anyone hasn't seen it on the most recent people that have been added to the team. So I think that's a good sign when you're kind of adding people during an environment like this. And I think they've seen kind of a bigger influx of interest from lawyers, legal teams, cases, et cetera.
Okay, thank you. More questions for John Oliver? If not, we can give him and Lindsay the rest of the night off.
That's fine. We're happy to stay on if you guys want us to.
Okay, you're welcome to stay on. Well, if there's no more questions, we'll move on to the next item of the agenda. I understand we don't have any retirees tonight, so that makes it a little short. I'm scooting back to the agenda here. There's no approval of benefits or approval of contributions. So the last item is the minutes of June 23rd. Shall we take a minute to read it and see if there's any adjustments?
I move that we approve the minutes.
Yes, I think they're well done. Is there a second?
I'll second.
Okay. Any discussion? All in favor? Aye. Opposed? Abstain? Unanimous. And unless I'm mistaken, that's the last item on the agenda tonight. So unless you want to socialize a little bit more, I would entertain a motion for closing the meeting.
Could you remind me when our next meeting is, please?
Yes, it is October 27th.
Oh, my God.
And one question I have for Maria, I mean, I realize you're doing the actuary study. If there's anything you need from us, feel free to give us a call.
Sure. Right now, they're just gathering all the census information for the actuary. So yeah, once I hear from Brad, I'll bring it up to the board if I have any questions.
Okay, well, if there's a motion to adjourn.
I'll make a motion to adjourn.
Yes, a second. All in favor? Aye,
Aye.
unanimous.
Aye.
And, enjoy the rest of the summer. Stay safe.
Take
Yeah.
care. Be safe.
Take care. All righty, well, good evening.